Follow the money. It always leads somewhere they didn't want you to look.
In 2021, the China Evergrande Group faced a financial reckoning of unprecedented scale, with liabilities exceeding $300 billion. Its collapse sent shockwaves through global markets. By the end of that year, over 1,300 projects in more than 280 cities were at risk of grinding to a halt. How did a titan of real estate development end up in such a precarious position? By 2026, the consequences of this crisis were still unfolding. Evergrande, once known for its rapid expansion, had grown its empire on a foundation of leveraged debt. As of mid-2021, the company was responsible for around 2% of China's total GDP. Its ventures ranged from real estate to electric vehicles and even a soccer team. Yet it was the real estate arm that built its fortune, and eventually its downfall. The company was emblematic of China's broader real estate boom, which fueled much of the nation's economic growth in the early 21st century. But this reliance on debt was a double-edged sword. In 2020, the Chinese government introduced the Three Red Lines policy. Financial metrics meant to curb excessive borrowing in the property sector. Evergrande found itself on the wrong side of these regulations. By September 2021, the company began missing interest payments, triggering fears of a wider economic impact. Analysts warned that Evergrande's collapse could be comparable to the Lehman Brothers incident of 2008. But a single spreadsheet entry would later expose the depth of its financial woes. More on that soon. The ripple effects were immediate. Real estate prices in China began to fluctuate, and investors worldwide watched nervously. Evergrande's stock plummeted. Suppliers, contractors, and home buyers all stood in line, uncertain if they would see their investments or payments fulfilled. Yet the most surprising turn was yet to come. Despite the chaos, the Chinese government remained largely silent in the early days of the crisis. This raised questions about Beijing's willingness to bail out such a massive corporation. Would they intervene to stabilize the market, or allow Evergrande to face the consequences of its financial mismanagement? The answer would have implications far beyond China's borders. In the midst of this turmoil, individual stories began to emerge. Families who had invested their life savings into Evergrande properties were left in limbo, unsure if their homes would ever be completed. Small businesses that supplied construction materials faced potential bankruptcy as payments stalled. Each story added a human dimension to the unfolding crisis. As the world watched, Evergrande's predicament forced a re-evaluation of China's economic strategies. Was this a warning sign of deeper vulnerabilities within China's financial system, or simply the fallout of a single company's risky practices? The answers to these questions could redefine global economic policies. By 2026, the dust had not yet settled. The repercussions of Evergrande's financial collapse continued to reverberate through global markets. But how did a single entry on a spreadsheet reveal the extent of the crisis? That revelation and its implications would challenge the sections of stability in the world's second-largest economy. The spreadsheet entry that would later surface came from an internal audit. It revealed that Evergrande's liabilities were even more precarious than previously reported. Not only did the company owe over $300 billion, but hidden within its books were off-balance sheet obligations, debt that had not been fully disclosed to investors or regulators. This revelation intensified scrutiny and eroded trust further. As the crisis deepened, foreign investors who had once seen Chinese real estate as a safe bet began reassessing their positions. Bonds issued by Chinese developers, once considered high-yield opportunities, suddenly appeared risky. The yield on Evergrande's bonds soared, reflecting the market's uncertainty. This shift in perception wasn't confined to Evergrande alone. Other developers with high debt levels faced increased investor caution, complicating their own financing efforts. The Chinese government, faced with mounting pressure, initiated a series of controlled interventions aimed at stabilizing the market. Local governments were instructed to ensure the completion of stalled projects to avoid social unrest. Despite these measures, The central government's reluctance to orchestrate a full-scale bailout sent a clear message. The era of unchecked borrowing and rapid expansion was coming to an end. In this climate of uncertainty, China's real estate market began to cool. Property prices, which had consistently risen for decades, started to show signs of stagnation. The construction sector, a significant contributor to China's GDP, experienced a slowdown. Suppliers and contractors, already burdened by Evergrande's unpaid bills, faced shrinking demand for materials and services. The broader economic implications were palpable. Yet, the impact extended beyond China's borders. Global commodity markets, particularly those tied to construction materials like steel and cement, felt the tremors. Countries with heavy trade ties to China, such as Australia and Brazil, experienced fluctuations in their export markets. The interconnectedness of global finance meant that shocks in one region could quickly ripple through others. By 2023, as Evergrande's restructuring efforts continued, the company managed to offload some of its assets to raise liquidity. However, this process was slow and fraught with complications. Many of its properties were sold at a discount, reflecting the urgency and distress of the situation. Investors, both domestic and international, remained wary, cautious of the risks associated with Chinese real estate. The episode served as a stark reminder of the challenges inherent in rapid economic growth fueled by debt. It prompted regulators worldwide to re-evaluate financial oversight mechanisms and stress-test their own real estate sectors. Was Evergrande an outlier, or a harbinger of more widespread vulnerabilities within the global financial system? That question lingered, challenging experts and policymakers alike to reconsider the balance between growth and stability. By early 2024, the ramifications of Evergrande's financial collapse were still unfolding. As restructuring dragged on, creditors saw only partial recoveries, highlighting the complexity of untangling debts that had reached such scale. Despite some asset sales, Evergrande remained a shadow of its former self. The once mighty real estate giant had become a cautionary tale about the perils of over-leveraging and the limits of rapid debt-fueled expansion. The Chinese government, maintaining its stance, refused a full-scale bailout, but continued to manage the crisis through targeted interventions. Local governments were tasked with ensuring the completion of housing projects to prevent social unrest. This approach reflected Beijing's intent to signal a broader shift in economic policy, prioritizing stability over unchecked growth. Internationally, the Evergrande saga prompted a reassessment of investment strategies. Real estate markets, particularly in emerging economies, faced increased scrutiny. Investors, mindful of potential hidden liabilities akin to those uncovered in Evergrande's books, demanded greater transparency. The fallout from Evergrande's collapse served as a catalyst for change, pushing global regulators to tighten oversight and enforce stricter financial disclosure requirements. Yet, questions remained about the long-term implications for China's economy. The real estate sector, which had driven significant portions of GDP growth, now faced a period of adjustment. As property prices stabilized, the construction industry saw a decline in new projects. This slowdown had a ripple effect, impacting industries from steel production to banking. The recalibration of China's economic model was underway, with the focus shifting toward more sustainable growth trajectories. The broader global economy felt ripples too. Countries heavily reliant on exports to China, such as Australia and Brazil, experienced shifts in demand, impacting their own economic forecasts. The interconnected nature of modern commerce meant that Evergrande's troubles resonated far beyond China's borders, reshaping trade dynamics and investment flows. By 2026, Evergrande's debt crisis was a case study in financial mismanagement and regulatory evolution. It underscored the need for robust risk assessment and highlighted vulnerabilities within global financial systems. As economies around the world faced their own challenges, the lessons from Evergrande's collapse resonated. The balance between growth and prudence was more critical than ever. The saga left one enduring question. In a world driven by rapid development and high-stakes finance, how can economies balance ambition with sustainability? As global markets continue to evolve, The answer to this question will determine the resilience and stability of future economic landscapes.